Okay, so I think we should start. Others might chime in, but let me welcome everybody who has joined us for today, which is the very first session of a new seminar series that we have launched at the Center on Political Economy, which has been created at Columbia University last year. As some of you might know, the Hewlett Foundation and some other foundations have sponsored several centers on political economy at different universities in this country. And we were the beneficiaries of getting funding for one of them. We have spearheaded several idea labs, including this one. So I'm launching now the idea lab on money and finance with this seminar series. And I would like to introduce briefly Matthias Thiemann. Maybe Matthias, you can briefly just say a word, so you will be on the screen for people who have speaker view on.
From Paris. Hello. Hi. Being here.
Yeah, Matthias is a professor for sociology at Sciences Po in Paris, a graduate of Columbia University. And I want to give credit to him for having had the idea of launching this idea lab with a series on the political economy of liquidity. I'll come back to this in a second, but let me just first of all also thank the organizers of the seminar series and our wonderful administrators at the center. Martin Naily is with us today. Catherine Burke could not do this for personal reasons, but they both have been wonderful in helping us organize the series and are standing by for any logistical issues that we might be facing and questions that you also might have in the future. The idea of this series is really to look a little bit deeper into questions that are directly related to power and politics in finance and money. And I think liquidity is really the juncture where it's almost inescapable to think about politics and power and to think about how we can use that lens to understand financial and monetary systems in different countries around the world, perhaps also at a global level. We have scheduled 4 sessions this fall. We are meeting roughly every 4 weeks. The schedule was dependent, of course, on the availability of our speakers, but you can look up the schedule on the Eventbrite website and schedule and register for all of these events that deal with questions of innovation, questions of sovereign debt, and also questions of on monetary support and its impact on de-risking or risk shifting, which are coming up in the near future. But I don't want to spend that much time on those. I really want to get going on our session for today, and I have 2 wonderful speakers. Both of them I want to still call part of the Columbia community. Charles Calomiris was with us for many, many years. We've been colleagues, but he now moved on to Texas to start a new university and a new department on economics at Texas. So Charles, thank you so much for joining us today as well. And then, of course, thank you. And then Nomi joined Columbia University just a year ago, but she's a new member of our faculty, and I just thought everybody would benefit tremendously from having her in this first round and hearing from her research. What we will do today is we will give each of you some time to share your thoughts on the readings, also to explain how your own work relates to this. And you will have both about 15 minutes. We talked about this before, and then we will open it up for questions later on. There's one more issue before we get going that I just forgot to mention. We would like to also organize an in-person session for people who are in the New York area, especially for doctoral students and postdocs. If you are interested in discussing these topics further in person, please drop me a mail or drop an email to Catherine. Just let us know in any way you can reach us that this is something of interest. We can organize happy hours. We can ask some of our speakers or other members of the faculty to join us for these sessions and just go a little bit deeper in brainstorming. And the last thing I want to say is that we will be announcing in a couple of weeks postdoc positions for the Money and Finance Lab. And if you're interested in pursuing that, please reach out with questions and do apply for this position. Okay, enough administration. We want to delve into the matters itself. And so, Naomi, I just give you the floor, and I'll just keep the time. I will try to be rigorous, but I won't interrupt mid-sentence either. Okay, thank you.
Great. Well, thank you so much, Catherine and Matthias, for the invitation. Very honored to be part of this seminar series. So my name is Noémie Lantoitier. I'm an assistant professor in the economics department at Columbia. my research is on the in the macro finance space, and particularly in the interplay between government interventions and corporate financial and real decisions. So kind of this topic is very much in line with the things I'm interested in. So what I'll do in the time I have is I first would like to spend a little bit of time on one of the papers of the reading list, which is a credit mediation paper I've worked on, and then use that as a starting point to kind of branch out more broadly on the link between insolvency and illiquidity as a market failure that calls for government intervention. So to start with the mediating financial intermediation paper. So this paper studies the effect of debt mediators in the resolution of corporate financial distress. And so what the debt mediation is, it's a process through which an external expert takes part in the negotiation process between a firm and its creditor in the event of actual or foreseen financial distress. And the goal of the mediation is to reach a non-legally binding agreement. So the role of mediators is to listen to all parties and help them reach a better solution to their out-of-court renegotiation process. And so this is a topic that's interesting for two reasons. First, it's interesting from a policy perspective. We know that financial distress is costly, and so any kind of new and cost-effective way to help the resolution of financial distress is of interest from a policy perspective. It's also interesting from a theoretical perspective, because basically what these mediators do is just they sit with you and they help you talk. And so from a theoretical standpoint, it's very unclear that mediations should have any effect. If we think that the bargaining process is frictionless, mediators shouldn't be useful in any sense. And so if we find that they are useful, maybe it can help us understand what are the underlying frictions in the bargaining process. In a nutshell, what we find in this paper, so I'm not going to go into the identification strategy, but just kind of name the big results, is that if for plausibly exogenous reasons, you have access to these debt mediators, so comparing firms that have access to firms that don't have access to mediators, we observe large fall in the probability that the firm enters formal bankruptcy proceedings and ends up being liquidated. And the order of magnitude is that having access to a mediation program reduces the probability that a firm ends up being liquidated by roughly 35 percentage points. So this is very large. So obviously it's a sample of distressed firms, so it has to be taken in that perspective, but large economic effect. And we find that this effect doesn't mean revert over the long term, suggesting that these firms were solvent and that we are avoiding inefficient liquidations. And interestingly, and closer to the topic of this session, we find this strong effect of mediators only for firms that borrow from multiple creditors, which potentially points towards mediators being useful in alleviating coordination frictions among creditors. And so a typical story for coordination frictions in debt renegotiation process is that each individual creditor does not want to extend additional credit because it wants to free ride on the provision of liquidity that other creditors could put in. And so here, one view of this paper is that it highlights the importance of coordination frictions in the debt resolution process, because we find large effect of mediators. It suggests that the effect of this underlying friction, so coordination friction, is also large. And so coordination frictions being one of the forms that liquidity crisis can take. And so I think one kind of big takeaway of this paper is to think about the difference between insolvency and liquidity, and in which ways policymakers can try to address illiquidity issues to properly sort insolvent and insolvent firms via the bankruptcy process. So to now kind of take a step back from the specific case of this paper and think more broadly about solvency and liquidity. So solvency is about having a net present value of your assets that are higher than the net present value of repayments on your debt. And so insolvency is something that exists even in a first best world. So imagine that you have a firm that has a negative productivity shock, then its efficient that this firm is that the assets of these firms are liquidated. Illiquidity, on the other hand, in almost all theories of liquidity, has to do with market failures. So if you think about the standard market microstructure models, the liquidity of an asset is typically tied to the extent of information asymmetries in the trading of that asset. So because any trader fears that other traders are more informed than him or her on the underlying value of an asset, you may be reluctant to trade with someone else for fear that they're better informed than you. And so that generates a bid-ask spread, so increased difficulty of selling an asset. Other market failures that lead to illiquidity are also typically agency frictions. So arbitrageurs cannot close arbitrage opportunities stemming from illiquidity on some assets because they cannot borrow funds due to agency friction. So the fact that they have to use the funds of someone else in order to close the arbitrage opportunity. And finally, as I've mentioned in the case of mediations, coordination frictions, and setups where we have multiple equilibria are also a very common way of modeling illiquidity crisis. So we're in a situation where investors can coordinate on a bad equilibrium where liquidity dries up, and this is self-fulfilling because when liquidity dries up, asset holders have to sell their assets at the fire sale price, and selling the asset at the fire sale price make them insolvent, which then confirms the bad equilibrium prediction that liquidity should dry up. So in all of these different ways of modeling illiquidity, market failures are at the core of this model, so very different from insolvency. And so what that means from a more practical perspective is that it's very important for policymakers, so both kind of government and monetary authorities to distinguish the two. And so just to take the example of the 2008 financial crisis, really we had the two alternative narratives going on at that point. So one narrative is that for some exogenous reasons, so a multiple equilibria sunspot, for instance, there was a liquidity crisis in the interbank market. Because of this illiquidity crisis, banks had to sell some assets at depressed price because they could not renew their short-term debt. They had to sell the assets on their balance sheet. And when everyone sells at the same time, this depresses the price of assets. And because banks had to sell assets at depressed price, this then generating an insolvency issue. So one narrative of the 2008 crisis was from illiquidity to insolvency. And so in this case, the appropriate policy response is basically to try to solve the interbank market crisis by having liquidity flood the interbank market. The other narrative was from insolvency to illiquidity. So the other narrative of the 2008 crisis is that banks had a bunch of bad assets on their balance sheet, in particular, all the subprime mortgage-backed securities. And because other market participants started to realize that the asset quality of banks was lower than expected, then they were not willing to renew the debt of banks. So for a credit risk motivation. And so this reduced liquidity on the interbank markets. And in this alternative narrative, the causality goes from insolvency to illiquidity. And in this case, the illiquidity, in a sense, is efficient. It's just going to be a way to have bad apple banks exiting the market. And so in this case, the policy response is more about regulating bank leverage and making sure that bank balance sheets are sound. And so that is to say that these different ways to see, so liquidity and insolvency, illiquidity and insolvency typically happen concurrently, and one causes the other, but understanding the direction of the causality is very important to understand the appropriate policy response. And so just kind of as a final thought, to go maybe closer to the core topic of this seminar, so because illiquidity is about market failure, we know that market failures are cases where it's efficient to have government interventions. First welfare theorem doesn't hold, and so we want potentially to have governments to intervene to prevent illiquidity crisis. And so I think it's a very interesting setup to think about the private versus public provision of liquidity. So I know Charles is probably going to talk about central banking. How far are we from the optimal private versus public mix when it comes to liquidity provision is a question that I think would be interesting to discuss afterwards. Thank you.
Thank you, Naomi, and thank you for keeping so much in time. I didn't even have to give you a notice to close. Thank you so much. I just hand it over to Charles now, and we're looking forward to your comments.
Thanks. Can you hear me okay? I guess you can.
Yes, yes, I
great.
can, for sure. Thank you.
It's a pleasure to be here, and congratulations on the new seminar. It's also a pleasure to meet Naomi, who I haven't had the pleasure of meeting yet. So great to be here with you. What I agreed to do is start with what I guess I would call a primer on thinking about liquidity and liquidity crises from the standpoint of intermediaries, especially banks, but not only, and then talking a little bit about issues relating to political economy, because those issues help to shape the way we think about the costs of liquidity. So there'll be a little bit of overlap with what Naomi said, but I think that's fine. So I'm pretty old. So when I started hearing about liquidity in the classroom, I guess it was 1977 when I took a course in money and banking from James Tobin. And James Tobin actually has an unpublished textbook, which we all got because we were in that class. He never published it. And he has this very nice graph of an asset price over time, where he says, if an asset is illiquid, the more illiquid it is, the longer it takes you when you want to sell it to realize its long-term value. So if you try to sell an illiquid asset quickly, you sell it at below its value. And if you're patient, you can get more value. And we can think about houses as being, for example, an illiquid asset from that perspective, or just about anything that's risky. And the reason is because illiquidity really reflects two different kinds of assumptions. One is a physical fact. So it may be very costly to convert because of the legal problems that you have to go through, which Naomi talked about. And of course, just contracting problems that can create delays and costs. So it would be very hard to sell your house to someone in a day or two just to be able to execute it. And then there's informational costs, which I'm going to talk about more in detail. But that has to do with what people can observe in the market that affects their willingness to pay a higher price. And so the time it may take to find someone who can figure out what an asset is worth may have a lot to do with the illiquidity of the asset. So what's a liquidity crisis? A liquidity crisis from this perspective is just a sort of outward shifting of this Tobin curve. So if it takes a while for your asset to achieve its long-term value, but if you have a liquidity crisis, it shifts that schedule far to the right. So it takes everything longer than it usually would. I also want to refer to the Brunermeyer article that I put in the reading list. And I think Marcus makes a really interesting distinction. And I think, as far as I remember, during the 2008 crisis and its aftermath, I think that's when he invented this language between two interrelated aspects of an illiquidity crisis. One is increased pricing effects from illiquidity, and the other is increased funding problems from illiquidity. So what does this mean? The pricing refers to the fact that risky assets prices tend to fall as a result of people scrambling for cash. So in a liquidity crisis, and I'll explain with an example in a minute, that when we observe in the price dimension a big decline in price during the crisis for risky assets, we think of that as a pricing illiquidity effect. And then there's a funding illiquidity effect. That has to do with people finding that they're unable to get access to the funding sources that they normally access. So again, scrambling for cash means that intermediaries, not just banks, as I'll explain, have to sometimes dump some of their assets, their risky assets, because their funding sources that had been used to actually fund those assets are contracting. So let's give an example of this. I'll give two examples. So let's take the Russian crisis of 1998. And by the way, this example I'm going to give you was used by a specialist emerging market hedge fund to test MBA students to see if they knew enough about the real world to be people that they wanted to hire. This was all they did. So they put a graph in front of them and said, please explain this graph. And the graph showed Brazilian sovereign debts denominated in dollars in 1998. They showed the big jump in the yields of those dollar-denominated sovereign yields and asked the students to explain why that happened. So here's the explanation that most people would give for that. When the Russian sovereign debt crisis happens in 1998, there is a class of hedge funds, emerging market specialist funds who specialized in sovereign debt and back then a little bit in corporate debt, but mainly in sovereign debt of emerging market sovereigns. And when the Russian losses happened, that meant that the perceived riskiness of those funds increased, but even more importantly, they experienced losses on their Russian portfolio. Many of those funds, hedge funds, were funding themselves from overnight repo. And the repo providers changed the amount of repo supply every day, depending on their risk assessment of the banks, so the hedge funds. So when the hedge funds lost equity value because of their losses on the Russian assets, that meant that they couldn't roll over as much repo as they had the day before. That meant that they had to immediately, that day, sell a large amount of their assets. They couldn't sell the Russian assets because there was no market for those. Those became distressed assets that were not readily sold in the market. So what they did was they sold especially Brazilian, but also other assets. And interestingly, the market didn't absorb those assets at the same price that had been the day before. And so that meant that the yield skyrocketed and went to that day more than 20% from single digits to a number that started with a 2. So that's what we call a funding liquidity problem. The hedge funds experienced a funding problem when they had a real loss on their Russian securities. They translated into a funding liquidity problem. So the pricing then is reflected in the fact that the Brazilian securities fall in value. So those are pretty basic. But I want to emphasize, you're used to hearing this about banks, where a recession or some kind of big shock causes loan losses. Banks, their riskiness has gone up. They've experienced capital losses. Their depositors, who are very risk intolerant, will then withdraw their funds, and that will cause the bank to have to shrink lending, which means that innocent victims, the Brazil of this story, is another borrower. So whether it's the Brazilian sovereign debt that's hit by the liquidity crisis in the hedge funds case, or the bank borrowers who are hit by it, one of the interesting things is you see that innocent victims find that the terms of credit that they're able to get in the market are reduced. Now, I think that when economists talk about this, they really don't spend enough time talking about an implicit assumption that's really important for understanding this. It's related to information costs. And that implicit assumption is that there's human capital stapled to specialized intermediaries. That is, the banker who's making loans, when that banker can't make loans as quickly or as many, then that banker is, because he's got special information about borrowers, that means that borrowers actually experience an increase in cost of credit. And similarly, even in something like the sovereign debt market, emerging market sovereign debt is really a very specialized business. Trading in it means that you're tracking the political risk of all these countries very much in real time. And so you can't just dump huge amounts of, let's say, Brazilian sovereign debt into the market and have it absorbed at the same price, because the problem is all the people who are most knowledgeable about those sovereign risks are finding that they're selling the assets. So who's going to buy them? Another example of this in 2008 was when Goldman Sachs experienced losses and lots of other US banks experienced losses. People who were heavily invested in banks and didn't have a lot of liquid assets other than bank stock, they were the ones most knowledgeable about banks, but they were also the ones least able to buy bank stock. And so that's why Warren Buffett was able to make a killing in buying preferred convertible Goldman Sachs stock, because he was in a position where, in a world where many of the most informed investors were selling that class of assets, he was in a position to be able to buy it. So that's how we think about these very basic things. Now I want to turn my last 5 minutes to talk about differences in liquidity costs across times and places that reflect institutional things. So obviously, risk management is very much influenced by regulations. For example, SVB recently, of course, was an example of horrible risk management, both ex ante, and it was all revealed by the outflow of deposits that brought them to their knees. But I want to emphasize that's really very much something that can be affected by regulation. So if the regulations had required SVB to mark its portfolio to market, for example, then it would have had to manage its risk much better. It would have had to go to the market early to raise capital to replace the losses that came from interest rate increases. And what's interesting is, not only did they not do that, but when they experienced an outflow of about $20 billion in the middle of 2022, more than 7 months prior to the crisis, what they did was they just went to the Federal Home Loan Bank to replace the private outflow of deposits with a government subsidized Federal Home Loan Bank loan. And of course, that was so the government didn't just fail to enforce good accounting practices and proper risk management, but it actually helped to subsidize bad risk management, which only postponed the problem and in fact made it worse. Market structure is also important. I have a paper with Mark Carlson, and many others are also writing this area, that shows that historically in the US, because we had a fragmented structure of our banking system with a lot of very small banks, like 20,000 banks at its peak all over the country, banks had to deal with their liquidity management through interbank deposits through what was called the pyramid of reserves. And this meant that, especially if you were, let's just take a bank that's in the middle of the pyramid, so you're in a medium-sized city like Indianapolis, on the one hand, you have your deposits in New York and Chicago. On the other hand, local Indiana smaller banks have their deposits in you. So you're facing a kind of two-sided liquidity risk. You're not sure whether the New York banks might suspend convertibility so you can't get access to your cash. And you also have to meet other banks' cash needs. And so what we show is that this kind of two-sided liquidity risk tended to accentuate the costs of crises relative to, let's say, a country like Canada that had nationwide branch banking and didn't have that pyramidal structure. And then, of course, bankruptcy laws, or just generally the adjudication of disputes in the credit markets, those things which Nomi also talked about, can, of course, lead to unnecessarily illiquid assets. And finally, safety nets themselves that try to address some of these problems can create ex ante through regulatory responses that are inadequate or sometimes more harm than good. They can make matters worse, make liquidity risk greater. And also, of course, the bailout decisions that the government makes create precedents that affect things going forward. When we think about the optimal safety net policy, the goal, which Luke Lavin and Mark Flander and I referred to as the Badgett principle. The goal should be to fix the problems at the lowest risk subsidization that's consistent with fixing them. And our point in that paper is the bigger the problem, the larger the risk subsidy has to be, because each mechanism for a sort of safety net policy works for different size shocks. So for example, collateralized lending has the least risk subsidy, but it only works for small shocks, as we described in the paper. And that's because if you try to help a bank by taking its collateral, as you take collateral that's the relatively good collateral, you actually subordinate the remaining creditors because you've taken the best collateral. And you can actually force worse kinds of runs on banks to happen. And in fact, that did happen historically. So if you have a small shock, collateralized lending can help. But even a moderate sort of major recession shock, really, it's not going to work very well. Then there's preferred stock purchases, which we invented in the US, as far as I know, in the 1930s. That can work, but only if the bank has enough existing common stock capital and is sufficiently solvent so that preferred stock, the rights of the preferred stockholder are basically a senior position. And if not, you get debt overhang problems that kind of vitiate the efficient allocation of resources. So preferred stock only works for kind of, let's call, medium-sized shocks. And then if you have really big shocks, you need either credit guarantees or common stock injections to really deal with the problem. So the point here is, and I think the literature in macro is sometimes not very illuminating about this. A lot of macroeconomists tend to think that financial shocks can be dealt with collateralized lending in some general sense. That isn't true. They can't be. And so that means there are big stakes about risk subsidies that are inherent to these mechanisms. So why don't we have optimal mechanisms? Well, this is my last observation. I'll stop here. Politics makes it very difficult. And here's the way I would point out the difficulty. Let's say that it would be desirable for us to sketch out some kind of mapping from the size of shocks to the kinds of interventions that are needed. And by the way, the Canadian government does something that's not too dissimilar from that. But now imagine if we were imagining a kind of TARP mechanism that would specify different kinds of interventions depending on the severity of the shock. Have it there in advance so that you didn't have to have this kind of ex post make things up in the middle of the crisis. I think we can all see a benefit to that. Who's going to be the first politician to raise her hand to suggest that in the House of Representatives or the Senate? And the answer is no one will, because they would immediately be attacked by all their constituents for being soft on providing government bailouts. And in fact, that would be enough to keep their mouths shut. So I'll stop there just to say, obviously, lots at stake. Politics will then intervene to determine who talks about what in advance. Almost nobody will, in the US at least. And then how the losses are allocated ex post. Of course, you want to be intervening as political protagonist, both in advance to try to get rules that are favorable to you, and very much after the fact. And I would say, if you doubt that, then see if you can come up with a good explanation, because I can't, that's not political favoritism, for why the Treasury bailed out 100% of SVB and Signature's uninsured debts. It certainly wasn't a credible systemic risk response. And so I think what we learn over and over again is how important politics is for how those losses are allocated. And then that, of course, makes it very hard to use economics to talk about optimal design of anything, because politics always seems to trump economics. I'll stop there.
Thank you so much. As Madeleine just put into the chat, if you have a question, please raise your electronic hands. I will take the prerogative of chairing and maybe give Matthias also a chance to chime in, to maybe just suggest some important issues that have come up. And I hear some background noise. If you don't speak Please mute yourself. The first issue, of course, is what is liquidity, and I'm grateful that I think both of you spoke to this. I found the definition that Charles brought in by Tobin quite interesting, saying basically the more it's sort of a continuum, right? So the more illiquid the asset is, the longer it will take for you to realize its long-term value when trying to sell it. So it's the opposite of being able to sell on demand at the price that you expect to realize its value in some way. So that's core for liquidity. I just like to put this out there and see whether people have questions about that. Another thing that I found interesting, the topic of the session was to tease out whether actually private actors can handle liquidity problems on their own. And if I read your explanations correctly, then I think both of you would say no. To a point they can, but ultimately they cannot. Naomi brought in the terminology of market failure. I think, Charles, in your paper also, you were pretty clear historically. We have seen that sometimes under some conditions, some banks can do this. It has a lot to do with market structure. Canada, with a few big banks, they have been able to manage some liquidity crisis historically quite well, but not a fragmented financial system. Ultimately, what you need to make it credible to have liquidity protection is I think, a sovereign that we need legal tender, as you say in the paper. So I think that would be an interesting starting point for our discussion about liquidity, that you always need a sovereign in the mix, unless you have very specific, very market structures that existed at some point in some countries, but can possibly not be generalized. So let me just throw this out as considerations. These are not really questions, but please feel free to respond and correct me if I got anything wrong. I want to hand it over to Matthias, who signaled to me that he does have a question. I'm waiting for participants to raise their hands. Thank you.
Yeah, thank you very much. Thank you both presenters. This was super insightful. I wanted to pick up on the insolvency leading to illiquidity versus the illiquidity leading to insolvency distinction, which I thought was two very important ways this can go. And I think that's already where a political economy resides, because how you distribute the losses and who takes the risk depends on which kind of story you're actually following. So I was wondering if these couldn't even be linked in a like spiral. And the second issue is the issue of risk subsidies. And here I'm particularly grateful for what I thought was the example of LTCM, long-term capital management, in 1998, and the hedge fund sector. So not only to focus on banks, but also on other actors such as the hedge funds. And my question here would be, in the context of the Financial Stability Board, the Federal Reserve, and the BIS today warning of the increasing leverage of hedge funds that threaten margins of illiquidity, very much in line with this Brunnermeier paper, whether we have not allowed a sector, namely the hedge funds, to basically become so leveraged that the risk of illiquidity and then therefore slipping into insolvency is very high. And if that doesn't in itself, from your perspective, wouldn't ask us to impose regulations. So in other words, are we not living in a world where there's a government put, like the backstop for hedge funds, if things go bad, without, on the other hand, the regulation that would be proper risk subsidy? That would be my question. Thank you.
So why don't you pick this up? I'm not sure who wants to go first, and I'm still waiting for others to raise their hands. So I'm handing it back to the speakers. Maybe, Naomi, did you want to maybe speak first, since you came first, and then I hand it over to Charles?
Yeah, sure. Well, thanks a lot first, Charles, it was very, very insightful. And thanks, Jürgen and Matthias, for the questions. I think so on Kevin's question, do we need government intervention? And does that depend on, for instance, market structure of the banking sector? I think the point you made is very interesting, right? Like, it may have worked in a setting with very concentrated banks, because the issue with liquidity is there is an externality aspect of liquidity, which means that private agents don't necessarily internalize the effect that their own decisions have on market-wide liquidity. And this is something that is partially solved if you have a very concentrated market structure, where every agent is kind of granular and thinks about his own or her own effects on overall market conditions. So in a sense, it kind of makes sense that basically when you have one agent in the financial system that is good at internalizing externalities, be it the government or another private agent, that can work and that can kind of circle to, there's now kind of this debate in the finance literature about these huge asset managers like the BlackRock and Vanguard of this world, on how having a very concentrated asset management industry sure is bad from a monopoly competition perspective, but may be good in the sense that these very large actors may be better at internalizing externalities, like, for instance, liquidity provision. So I wouldn't say that it has to be a government. I would say kind of historically, it seems that governments are good at internalizing externalities, but we can also think about private agents who can take up that role. Then on like kind of insolvency, liquidity, and how that affects the sharing of losses. Yeah, I think this is very true. I hadn't thought about this aspect, but basically, if this is about an insolvency crisis, you want the insolvent agent to be liquidated and that agent's stakeholder to take on the losses. If you think it's an illiquidity issue and an agent like the government provides liquidity, then liquidity is a public good in a sense. And then at least what has happened in practice is then the losses are borne by taxpayers, the population in general, because the government, by providing liquidity, is providing a public good to the whole system. So I hadn't thought about this aspect, but it's true that depending on how you read the source of the issue, this may actually imply different sharing of the losses. And then on kind of big hedge funds and this idea that basically they're protected on the downside, but there is not counterpart in terms of regulation. This really makes me think of the debate on deposit insurance, which is a bit of a similar issue, right? In a sense, deposit insurance protects bank from bank runs, which is a form of liquidity crisis. But if not priced correctly, it means that, and not accompanied by proper regulation on bank restaking, this is basically providing a subsidy to bank restaking and potentially also crowding out the monitoring that depositors would exert on banks if there was not this deposit insurance. So it feels like this is an issue we've been able to address in another context. And so, I mean, it seems to me that similar principles should apply in the setup of hedge funds. And to be honest, I don't know why they haven't. I guess because maybe it's a newer, like bank runs have happened for more than a century, and maybe just the hedge funds is kind of a newer industry and we're not very at. But I don't know. I would say similar principles should apply in this case. And yeah, that's it for me.
Charles.
So this is an interesting discussion. I think that the key to how you think about who's most potentially contributing to systemic problems has to do with how they fund themselves. So my view is that a hedge fund that's using a lot of overnight repo in its funding is properly the subject of regulation. But so that we could imagine capital standards for such hedge funds, but then there would be a safe harbor if the hedge fund switched to not focusing on repo funding. It could avoid the regulation coming from the. So I think if the issue is it's the funding sources risk intolerance that and very short term maturity that creates these kinds of very big risks. We don't need to apply such regulation to everyone. For example, I don't want it applied to me in my portfolio. I should be able to decide my own debt as a firm, let's say. But if I'm a repo borrower, then I think it's a little different. So I want to emphasize something about this, which is also related to this question of solvency versus liquidity. So first of all, every financial crisis that I've ever studied begins with a real shock. So this means that there's always, at the beginning, at the source of the problem, an elevation of insolvency risk. Okay, so notice you're in some position before the crisis, a shock comes, it makes your capital fall because of losses, and it makes the risk of your remaining assets go up, which means your default risk rises. Everybody experiences an increase in the default risk if you're a borrower, if you're an intermediary, when there's that kind of a shock. What's key to understand is that the most problematic kinds of debt that tend to lead to these systemic problems are those that are risk intolerant. So if banks or hedge funds were borrowing from debt sources, funding sources, that were willing to just keep supplying the funding at an elevated spread, then there wouldn't be the problem of funding liquidity risk. And this is not emphasized enough outside the banking literature. I want to emphasize it. It's the risk intolerance, not risk aversion of short-term debt that's so important. The fact that repo lenders are not willing to be paid a higher spread. They require virtually riskless spread. Similarly, depositors historically, it's not just runs, they'll withdraw from banks that have elevated risk, sometimes in a very orderly way, as a way to create that incentive for the banks to manage risk. So I want to emphasize that we should really be focusing on two aspects more than we do. One is it's about insolvency risk, not just about insolvency. A bank or a hedge fund could be in perfectly good shape, but if it experiences an elevation in its insolvency risk that makes it impossible for it to continue to roll over the risk intolerant source of debt that they rely on, then they have a liquidity problem, even if they're clearly solvent. They will have the same problem. So it's not just about being insolvent. And so my view is it's those kinds of sources of debt that should be the focus of where we intervene on a regulatory basis, which means if you're a hedge fund and you want to borrow 1-year debt or 5-year debt or even 6 months of debt, I would say that gives you a safe harbor because you're not buying risk intolerant debt. But if you're buying overnight repo, that's how you're funding yourself, basically you're acting like a bank.
So I think that's an interesting point just to note for regulatory interventions, how to rethink the governance of these financial markets in light of what we understand now about the core liquidity issues. I do see a hand up, Yuri Biondi. Very nice to see you here, and thank you for raising your hand.
Thank you, Katerina. Thanks for organizing all this series of seminars. I was thinking exactly to this point about debt and funding. So actually, Charles had already started responding, but because Noemi has mentioned the point of the funding and the debt role. Debt, so the source of funding for this hedge fund, which make the market, that market we are talking about, are critical. And you have been discussing a lot about the micro dimension, so at the hedge fund level. And I think this is also very important at the more systemic level because of the interaction and the chain of repos. So the long chains that every asset start to be leveraged again and again among a close circle of actors. Sometimes I think these networks are very close, very intense. And at that point, I'm no longer sure that you can just say it's like a bank. Okay, it's short-term debt in the sense like a deposit for the bank. But those deposits can be a quite stable source of funding in aggregate and over time. And this is much more focusing leverage over the same basis, and that the basis in itself, the basis for the market they have been creating. And so everything is so systemic in a sense and so intensively connected. So my point is more a consideration, but I'm really intrigued by listening to you about this more macro or interactive or systemic dimension of this specific point. Thank you.
Since we don't have more questions right now, I'm just turning it back to the discussants here. Charles, you want to chime in? I think this was directly, but I think Naomi, you can come back as well.
Yeah, I really thought the point was interesting too, that if you had stable funding, so let's say you had retail deposits that, and forget about deposit insurance because that complicates things. But let's say it's just your depositors are very stable and they just aren't going to respond to just a day or a week. They respond more slowly. So if you have more slow response, that means effectively these externalities from the liquidity risk are reduced. And so that it's really these wholesale markets where the response is both risk intolerant because they're targeting very low default risk and that they're very responsive. That I think that's really something that we want to focus on as a worry. And I think that where that leads us is really to broaden the discussion. You know, just recently, one macroeconomist said to me, or said in public at a conference, well, if there isn't a payment system issue, then there is no liquidity risk. And that's just not the right kind of thinking, right? It's not, hedge funds are not payment system providers. They're just doing pure credit intermediation, but they're reliant on a source of funding, which repo is not itself necessarily a payment kind of thing, although it can be used for that. So I think we have to get to the microeconomics to really get to this. And when we focus in on it, it's not about payment systems. It's really about, again, this risk intolerance aspect of certain kinds of very short-term funding sources, I think.
And can I just throw in like a two-finger, but isn't it the case that the only really, the only instrument that is always available and basically meets the risk and tolerance of these investors is state-issued money? So aren't we back at the macro level here?
You're saying that in a liquidity crisis, at least under the current kind of regime, people think of liquidity as always coming down to how quickly can you get to cash? I think that's true. And cash, the state has a monopoly on cash. That's very true. Of course, you know, as Nomi pointed out, sometimes private coalitions can get access to cash collectively, so that, you know, that has worked sometimes. And sometimes private coalitions have even created substitutes for government cash. For example, clearinghouses in New York City did that, and others. So you're right that you're ultimately people want to know in the middle of these crises, how much do you have the capability to grab cash? And then cash has an option value that becomes special during these crises, because if you look at your balance sheet and you say, oh, look how much capital I have. Well, that's very dependent on the valuation of your assets, how much capital you have, right? But cash, the value of cash does not depend on the valuation of any assets. So there's a unique option value during crises that comes from cash. So in finance, we often think about the balance sheet as sort of, you know, the default risk is the result of all these complicated things like, you know, capital ratios and all that. But the truth is that there's a unique aspect to cash because it has option value during crises and debt doesn't, or debt capacity. So you might say, oh, I have very high capital, lots of debt capacity to issue more debt if I need to. But that debt capacity can go away very quickly in a crisis. Cash, if you choose, let's say you're a bank and you choose ex ante to rely more on cash, compare yourself to a bank that chose to rely more on capital. The bank that relied more on cash during the crisis has option value that the other bank doesn't have. That's the main reason, actually, I believe, that we should have cash requirements as part of prudential regulation.
Thank you. Now, if you want to chime in.
Yeah, sure. Yeah, I think this macro question is very interesting. And I mean, actually kind of within the literature, liquidity, on top of being used for as like market liquidity and funding liquidity, is also used differently at the micro and macro level. Like at the micro level, liquidity kind of corresponds to the definition that Charles gave from Tobin, like specific to an asset. What is the speed at which you can sell this asset, realizing this full value? But in macro, we often, and in monetary economics, we also often use the term liquidity to think about the aggregate quantity of liquid assets in the financial system, which is a bit of a different definition in the sense of liquidity. That said, that second definition relies on the first, right? To determine what's the aggregate quantity of liquid assets, we have to think at what at the micro level makes an asset more or less liquid. So still, I think the micro view and the underlying frictions that we discussed, so agency frictions for arbitrageurs, information frictions, coordination frictions, I think those are the micro level frictions we should study to understand liquidity. And then obviously, once we've identified these frictions, the micro and the macro views complement themselves because there is spillovers and transmission of risk in the financial system. And so I think this is what typically policymakers have thought about when they distinguish micro level financial regulation, like, for instance, bank level capital requirements, and what has been called macro prudential tools, which has to do with how the financial system as a whole is interconnected and the building of systemic risk. So I completely agree. I think both dimensions are very important to understand kind of market wide liquidity shocks. And so on the question of, is cash at the end of the day like the ultimate liquidity safe haven? I think it's more of a spectrum. There's this whole literature now on safe assets. And so the characteristic of safe assets is basically liquid assets, the value of which doesn't fluctuate a lot with the level of risk, economic shocks, etc. But what has been shown in this literature is, so first, these safe assets trade at a premium because people value this liquidity. So a lot of the modern macro models have agents that have idiosyncratic liquidity needs, for instance, because they have like any form of shock. And so in these situations, having assets that you can sell quickly has a value, and so you can generate bubble components of these safe assets in a large class of model. But what's been shown is that you find this safety premium or liquidity premium not only in cash, but also on other assets, like, for instance, very safe government debt. And also more recently, and so by a graduate student of Columbia Business School, so maybe, Charles, you know, the paper by Lira Mota, she showed that the debt of some corporates also had this safety premium component. So basically the bonds issued by a company like Apple also have this safety premium, which is a part of the yield that is unexplained by the default risk. So to me, it's more, there's a continuum of agents that issue securities that can provide these safety services, governments being a prominent one in developed countries, but maybe if we were in Argentina, the corporate bonds of Apple provide more liquidity services than government issued currency or debt.
Matthias?
Yeah, thank you. I wanted to get back in on the macro level, follow up a little bit on what has been said by Charles about cash reserves. And I wanted to ask a question, basically, in your paper, the one with Lavin and Flandreau, you observe that the interventions of the lender of last resort has moved from the Badgerhood rule, which is lend freely, but with a discount, right? At a discount, to bail out, undiscriminating, and like big bazooka kind of thing. And I think almost we could take the recent Silicon Valley Bank thing as the absolute expansion of this, like the absolute anti-Badgerhood rule. So instead of any imposed risk sharing being imposed in any disciplining effect, we're going to take 100% at par, you know. And I think some of the things that happened during COVID in the US were similarly almost on par. And my question is here, is it possible that the budget of flexibility, to use non-economist language, so that the budget of flexibility, to cite Gregory Bateson, of the system has actually been extremely reduced? So basically my thinking is still we're surfing, everything seems fine, and but because of these actors that are so risk intolerant, as you put it, when anything happens that doesn't go according to what is expected or whatever, the thing can flip immediately. And so the lender of last resort function has become this like firefighter function, which is like when there's the smallest spark at the smallest possible place, you go all in. So you don't ask questions, you don't do a discount because you're afraid to increase this. And if that's the case, then shouldn't we put much more cash reserves, as you put it? Shouldn't there be much more like simple common sense kind of things like, and if that's the case, then why don't we get there? Why are we pretending everything is fine when things seem to be very easily inflammable, to put it like this?
I think it's a political outcome, not an economic outcome, that makes things so fragile. That would be the first thing I would say. And let me just point out, we have two very nice papers that I think most economists have heard about, that were written by Amit Seru, Tomek Piskorsky, and some other authors. And basically, they're estimating, just based on looking at the balance sheets of the existing banking system in the US, that there are probably 600 US banks that, as a result of commercial real estate risks and government bond risks, are at the point of insolvency. Now, that has not created a regulatory or supervisory response. Why? Because of politics. If those banks weren't insured, and if they weren't protected by the government, they certainly would have been forced to respond by the market. But they're now going to, of course, if we have another big rate increase, or we have some sort of major commercial real estate problem, then there's going to be a crisis, and everyone's going to say, oh, look at how everything is right on the edge, right? No, it's not right on the edge because of economics. It's right on the edge because there's no political will for supervisors to do their job, to actually make those banks recapitalize now or a year ago. And so then when it all blows up, it's going to be like, another major 1980s, and everyone's going to say, look how fragile the banking system is. Well, it's fragile by design, if I can quote my own title, right? It's fragile by political design. So what we need to really think through, and I won't go into it in detail, but this is, I think, the most important topic, is to come up with what I call robust regulations and robust supervisory rules that actually make the regulatory and supervisory system not allow banks to go to the very edge, so that then we get a systemic shock and everything blows up in our face. But that's probably what's going to happen, right? We're going to have it because we're so tolerant of the risks now. And I was at the Federal Reserve Bank, I won't say which one. I was sitting at a table with all these policymakers, and what they said when I said was, why don't you guys do your job? The answer was, well, what do you want us to do? Force the shrinking or closure of a lot of small banks in the US? We already have a too lopsided banking system with large banks. So the point is, well, I may agree with them that we have too large a concentration of banking in the four banks, but that doesn't mean that you don't do your job in supervising the banks. I'm quoting them. I'm not making this up, right? That was their answer to me.
So I want to.
Oh, sorry.
No, you have the pro. No, go.
Yeah, if I can come in on this and take the opportunity to advertise the work of a fellow young macroeconomist, Christian Müller has this paper on electoral cycles and macroprudential regulation, where he shows that in the run-up to elections, in particular when elections are contested, you see a loosening of macroprudential regulation. So basically all the policies that had to do with like tighter lending standards, especially for consumer loans or mortgages, typically get more lax as you approach elections, in particular when these elections are contested. So I think like this paper is a great kind of empirical evidence that political economy constraints seem to matter tremendously for the implementation of these risk mitigation policies. I'll share the paper.
Maybe you can, if you have the titles and you can throw them into the chat, that would be great. So we can read up on that as well. Let me just push a little bit, because I think it's really interesting to think about how we think about politics. So if we go back to my earlier interventions, and I said, it looks like only legal tender will do the trick for in times of crisis. And I think Charles said there's this option value of having this basically unlimited spending. Now, I take Naomi's point that maybe Argentina can't do it, but that has also something to do with the structure of the monetary and sovereign debt system of Argentina, right? If you issue your own sovereign debt in foreign currency under foreign law, you are no longer a monetary sovereign. So what I mean is a true monetary sovereign that can do it, and nobody else can do it. Every bank faces a binding survival constraint or a limited budget constraint or something of that, but sovereigns don't. And I think so once we recognize that, and I think we also have to think about politics as not this other that is either intervening at wrong points or failing to regulate with markets. But it's sort of, as you know, Merling called it at some point, it's a hybrid system. It is necessarily and always intertwined and interdependent. And then we have to think about how the system has evolved over time. I'd like to go back to Charles' argument in the paper that he circulated with Luc and others, where I think there's a story, which is an interesting story, that after World War II, in part because of politics, democratic politics, but I think also in part of changes in the market structure. We're getting that by saying it's not only banks, it's actually increasingly markets, it's increasingly relying on refinancing, etc. How we have gotten into a position that nobody dares to touch a financial system that is clearly free riding or using the the put option in the end to be safe from its own activities in the end. How we got there and why the government under these conditions is so incompetent and so unable to act. And so I just want to get a little bit closer at this political economy, rather than saying, of course, when elections approaches, they won't dare to call a financial crisis. Of course not. I think it's obvious. But at the same time, if we think of the system as interdependent and hybridic, then we also have to think more clearly about sort of what contributions both sides make to the system. And that includes creating hedge funds in the gaps of existing regulation. I mean, that's, of course, one of the arbitrage, not only financial arbitrage, legal arbitrage is one of the greatest techniques that the financial sector has also exploited, and where regulators will always be a little late. So I'm just want to throw this in as just a kind of different perspective. Hear your thoughts, or maybe I know that Matthias also wanted to chime in later on, and there's another comment. Maybe Chen, I'll take you on, and then I'll turn it back to the speakers. Please unmute yourself and ask your question.
Yeah, thank you, Katrina. So this is Chen from the Chinese University of Hong Kong. So my question is, well, so I find all of these comments really insightful. So my question is, given the fact that, well, ultimately the liquidity support from the government can be very essential in providing the stability of the system. So I'm wondering, maybe more active common equity injection from the government might be a sort of mechanism to solve this problem. Charles comments on these three different types of shocks, right? Collateralized lending, and then the preferred stocks and common stocks. So from the Asia's perspective, so I'm wondering, maybe in the future, so having some government investment vehicles sort of playing the Warren Buffett's role, right? It's kind of in the market and providing liquidity when the crisis arises, but in exchange, right? So having common equity to get the potential upside, right? And these kind of vehicles, they do not face this kind of funding problems because of the sovereign backstop. But on the other hand, they can have the longer term horizon in terms of investment and also the value oriented investment perspective. So I'm wondering, maybe some kind of mechanism design like that perhaps could be a way of providing long-term liquidity solutions. So I'm wondering if you could comment on this possibility.
Thank you.
Yeah, so I'll give a very brief response. So my point in theory, of course, is I want to really distinguish theory from practice here, because in theory, there's no politics, and in practice, there is. So in theory, if a really big shock happens, you will need to have some equity intervention. Preferred stock won't be big enough to do it if there's a big systemic shock. However, I would emphasize that is itself not something that you should think of as very common. Canada is a commodity producing economy. It has more volatile GDP than the US. It's never had a systematic banking crisis, much less common equity injections by the government. So I would say that what that reflects is good regulatory system design, at least through most of its history, if not all. So I think it's true that there's a role potentially for the government in this, but I would say that if the system were set up so that regulation and supervision were doing their job properly, you wouldn't get those big shocks, right? The big shocks are the result of the fact that you've not done your job, and especially if you're protecting banks, which is another policy decision, and then you're not doing your job, then it all blows up and you have to start using these things. So from a practical concern, I don't really like the idea of, first, the government causes big shocks through the combination of protection and incompetent regulation and supervision, then says, oh, now we have such big problems, we need to be in charge of everything. That seems a little bit circular, right? So I think the real answer is, let's design the regulatory and supervisory system so that we have less shocks in the first place. And then maybe we won't need too much of this common stock injections. We'll be more like countries that have managed to avoid shocks. Let's say Canada, New Zealand, Malta. You want to have the banking system of Malta, not the banking system of the US.
For the US, so Matthias.
Yeah, thank you very much. I think this is super interesting, and it gets back to this issue of regulation and supervision. And I want to be a little bit in defense of the regulators or the supervisors, or just to make a few points. I think the first one, and I understand that economists tend to point to politics as the outside, where the instability comes from, and the electoral cycles, but there's also all literature on the procyclicality of the financial system itself. I mean, you can stand to that as you like, but people like Tobias Adrian, Shin, Bruno Meyer, and so on have written on this and have shown that there's a certain procyclicality, in particular by broker-dealers, which is what they've been the most concerned about, both in the upswing and in the downswing. So there's an inherent tendency of the system to get close to the edge. It's not only the politicians that do it. But the second thing, in defense of regulators or of supervisors, maybe, in the United States of America, they did try to impose some kind of macroprudential regulation through a guidance. The Fed did a guidance in 2013, I think, on leveraged, not leveraged buyouts, but CLOs. And basically that was actually justified with the safety and soundness of the system. And in 2017, it was appealed by the banks. And in 2017, it was kicked out by the federal, by the administration law court in the US, saying that the Federal Reserve seriously overstretched their mandate. So I mean, I'm just trying to say, if you read the Federal Reserve reports, they will tell you there is a cyclical upswing in investment in commercial real estate before 2020. So they kind of knew it. They kind of said, okay, there's a problem, and then they didn't really have the tools. So I find this debate on how to set up regulation and supervision super interesting. At the same time that we acknowledge that these guys kind of also know a little bit what's going on. It's just that they often don't have the tools. Thanks.
I'd like to...
Oh, sorry.
Jerome, I'll come to you in a second.
I just want to say, I don't think it's true. And of course, this is something that the Fed regulators especially are talking about now. I'm noticing a lot of academics are saying, oh yeah, supervisory tools don't really exist to allow supervisors to do their job. That is not true. Okay, so let's be clear. And someone asked this question, I didn't get to address it yet. What's the difference between regulation and supervision? Regulation establishes minimum requirements. So that CLO requirement actually was probably a bad regulation. I agree with the decision not to allow it. It was not based on good research. And I don't think, in fact, research by people at the New York Fed has kind of shown that it was poorly designed, even to achieve its purpose. So that was a bad regulatory decision. But supervisors have the power to go into a bank and say, notwithstanding the existing regulations, that's what supervision is all about. We see a problem and you have to increase your capital. The minimum capital requirement is just that. It's a minimum. Supervisors can tell you, increase it. You are in trouble, fix it. It's the lack of willingness to act by supervisors. It's not the lack of power to act. And by the way, I spent a year at the OCC as chief economist, And I can tell you that people are aware of a lot of weak banks. And in my opinion, it's an agency problem of supervision that's really the problem. People don't see, first of all, they're not accountable for deciding not to act in a timely way. There's no accountability for that to any individual for failing to act in a timely way. And there's lots of potential risk to you if you act and then some politically influential large bank calls up a politician. And if you think that doesn't happen in the UK and the US, much less everywhere else, you're wrong. It does happen. So supervisors need to have rule-based interventions based on observable signals with a presumption of action in a timely way. We haven't had that. Supervision's been broken for at least 50 years in the US because there's no accountability, there's no timeliness, there's only excuses.
I'll take Jerome now, and then I'll comment later. Jerome.
Thank you. So I had a question that was a bit following up Matthias' point, and I think actually, Charles, you already started to answer it. But I'd like to have your opinion on basically the whole debate around rules versus discretion. Is a rule-based and regulation-oriented financial system, if we redid the whole regulation of banks, would be enough? Or would you still think that there is a certain amount of discretion of macroprudential contracyclical intervention that is still needed at some point?
Charles?
It's a tricky question. I'll just try to be quick and say, I think the most important thing is that you have to require someone to be accountable. So if you have discretion, I'm not against discretion per se, but there has to be accountability. So for example, when I was at the OCC, I pointed out that putting on the supervisor's dashboard some kinds of market signals of problems at banks would give them a red flag that would allow them to intervene. And I argued that if that signal was somehow something that we required supervisors to pay attention to, because it's observable to people outside and inside, it would create a kind of transparent accountability for discretion. It may still be that the supervisor needs the discretion to decide something based on some internal knowledge. Maybe that makes sense. But the problem is you can't just say there's no rule, there's no account, because then there's no accountability. So I think that we need to put supervisory dashboard requirements that create a kind of fire under the supervisors that says, look, there's a presumptive burden on you that if we can see that banks are in trouble, you have to do something. You have to do it fairly quickly. If you want to use your discretion to positively not do something, you're going to be accountable for not doing it because it's something that we see a signal about. The problem is right now, there is no signal, there is no dashboard. It's a bunch of agency problem that's leading to no action. And that's been the presumption. I mean, we've never had supervisory action. Supervisors have never been proactive to prevent anything bad from happening. I mean, it's ridiculous. I could point to examples in the 1970s, the 1980s. I could go on and on and on. Why do they act this way? Because they're government bureaucrats that aren't accountable for actually doing anything.
So I just can't help sort of seeing a parallel to what I'm trying to teach my students right now about fiduciaries and corporations. And one of the most difficult theories the judges always say in fiduciary theory is to deal with fiduciary obligations because of non-action. So when you do something really bad, then we catch you. But the failure to act is one of the most complex issues. But fiduciary duties are there to catch that too. And the general rule is if you fail to act in the face of a known obligation to act, then you're liable. And I think you're basically pronouncing something similar with specific dashboards, because we're talking about public interventions with powers that might have to be constrained. I'm just sort of seeing also another question in the chat by Julian Jogenmeyer, who asked, wasn't achieving that greater accountability what the Fed tried to do with CCAR? So I think one question I also have had in my mind is whether the regulatory reforms post-2008 actually have failed, given what we're currently discussing here and what we've seen with Silicon Valley Bank and other issues. Naomi, I'm not sure whether you want to chime in and maybe share your thoughts on this or the other questions that have come up.
I think I'll let Charles, because I don't know the Fed framework as well as he does. So I think he has a comparative advantage here.
Charles, you want to just share another comment?
Yeah, I think that I'll just, obviously it's a target-rich environment to talk about regulation failures, right? That's the battle analogy. It's a target-rich environment. But I want to just say something to get all of you thinking about what's deeply wrong with this regulatory structure. And that is, it's all based on balance sheets. Now, banks are not balance sheets. Banks are service companies. And then you think, well, what difference does it make? Why am I saying that? Because a lot of what affects bank risks have to do with cash flows that have no counterpart on the balance sheet. So the whole idea of trying to establish prudential regulations and supervision based on balance sheet, kind of focusing on tangible assets, is really not correct. We went down that road in the 1980s, especially, but it was the wrong road. And Basel has never looked back, neither has the Fed, neither have the others. What we need is cash flow-based regulation that uses finance theory and uses observable market outcomes to think about risks and to think about equity capital. So, but what does the stress test do? It's all about how do you exit based on tangible book equity. So Citigroup has a market value of equity for over a decade that's a fraction of its tangible book, because Citigroup is a very poorly run institution with lots of bad cash flow forecastable into the future. JP Morgan has a market value that's a multiple increase above its tangible equity. Which bank is safer in the stress test? That, guess what? You're going to laugh, but based on this, many of the criteria of capital ratios or stress tests, you could sometimes conclude that Citibank is safer, but that's ridiculous. JP Morgan has huge economic value that's not even recognized in its stress test. So the whole regulatory framework, it can be fixed. I wasn't at the OCC long enough, but we started developing what I would call fundamental cash flow based ways of thinking about prudential regulation. You don't have to start by thinking that banks are balance sheets. That's for idiots, but that's where we are all over the world.
Matthias, did you have your hand up?
Yeah, thank you very much. And this is really good. Discussion is getting great. So I think the cash flow based element is really very welcome. To bring it to the political economy of liquidity, there are today at macroprudential regulators, they're developing stress testing of markets. I'm not saying that they have it down to the iota, they're not there yet, but they're seeking to use stress testing for the markets exactly, for example, to justify why asset fund managers can only hold certain assets and not others because these are deemed too illiquid and so on. So there's development, to say it like this, and I think focusing on this and on liquidity is really key. I have a question on this dashboard thing. I agree, it makes a lot of intuitive sense actually. So I'm actually playing the devil's advocate regarding an idea that I really like a lot. But I observe with the macro pro guys that they were always like, oh, we don't want to talk about problems because when we talk about problems, then there will be more problems. So they're like, we can't publish our dashboard or we can't publish the real information because then everybody's going to get spooked and run. And so we don't want to cause a crisis by talking about the possibility of a crisis. I was just wondering how that could be integrated in the thinking.
Yeah, if I can there's an interesting literature in finance on the optimal level of transparency you want to have in markets. And it's been shown that for some markets, so for instance, typically for money-like instruments that we want to be very liquid, it's actually optimal to have a form of opacity, because the reason why we want to have these assets is that we want everyone to save on the cost of acquiring information. But that works only as long as there is sufficient prior in the financial system that the risk related to that asset remains low enough. And so it seems that there's kind of a trade-off between, in normal times, you don't want to have necessarily full transparency because this would then need all agents to spend more on information acquisition cost, which is exactly the reason, like not to do that is exactly the reason why we want to have information in sensitive liquid assets. But then obviously that changes in crisis times when, for instance, when the situation where you can have multiple equilibria starts existing because fundamentals are not strong enough, then revealing the information becomes optimal. So it seems like even from a theoretical perspective, it's just not clear whether you all the time want to have the highest level of transparency.
Yeah, so I think that's a great point. I would say that is why it's very important for interventions to happen at very high trigger points. Because once you get into these, like, you know, when I remember at the Bank of England in 2013, I think it was, they had a closed door session on how to think about COCOs and convertible COCOs. And Doug Diamond and Charles Goodhart and I were there. And on the spot, we all came to the same conclusion, which was the way that they were talking about this regulation made no sense, because the COCOs were going to be triggered at a time that was already very vulnerable. And so Charles wrote an article called "Are COCOs from Cloud Cuckoo Land?" Right? But then after I wrote an article proposing high trigger COCOs, Charles advocated that in a very long op-ed that he wrote in the Financial Times. So I want to emphasize, I think the right answer is you don't have this multiple equilibrium problem. You don't have this issue at all if you act in a timely way at an early point. Let me be concrete. Citigroup's market capital to market value of assets in April 2006 was about 13%. What you can see is that the banks that were intervened, both in Europe and the US in 2008, had a steady decline of their market value to of equity to asset ratio from 2006 through 2008. The banks that weren't intervened kept that market value ratio sufficiently high, like above 5% during the crisis. But Citigroup lost most of that in 2007, long before the crisis. If there had been a requirement that the true economic value of equity had to be, let's say, 10%, then we never would have had a financial crisis. There would have been no kind of problem. You never would have gotten close to the trigger point that would have led to the systemic crisis. So I just want to emphasize that's the issue. You know, when Citigroup was intervened in December 2008, Citigroup had a book value ratio of 12%, but it had a market value ratio of 2%. So what's going on there, right? And they weren't all the same. So, you know, JP Morgan didn't need intervention. Wells Fargo didn't need intervention. That also shows itself in their market value ratio. By January of 2008, there needed to be hugely more capital issued by Citi. The markets were open, but the regulators didn't require it because they were focused on balance sheet thinking of tangible assets and other such things. If you had looked at the market value ratio, you would have said this bank is close to insolvency. You had plenty of time. The crisis didn't happen over a weekend. It happened over a year and a half.
True. That's true. So I'm afraid we're sort of getting to the end of our session. Let me just before I thank our speakers, let me just sort of put a couple of things out there. First of all, this is the beginning of a debate. I think we will come back to many of these topics in future sessions, and I would invite you to come back. I also want to note that we are placing the readings for each session in a folder that you can access once you have registered. And we would encourage you to do the readings, because then we can have a level of debate and with more participation that really allows us to go deeper into the important issues that we're trying to maybe we're not solving them, but to illuminate perhaps at some level. I also want to reiterate that we would like to have more discussions, particularly with postdocs and doctoral students, if you want to do this in person, and let us know. And finally, if you do have readings that you would want to suggest, what we talked about, some people are already doing stuff into the chat. chat. If you have readings to share, send them our way once we close the session, or put them in the chat before we close. Having said all this, it's 1:40. I promise everybody will be on time. So I want to thank very much both Naomi and Charles for sharing their thoughts on this really important issue and being such vibrant discussants here. I want to also thank Matthias, my co-chair, and thank all the audience members who came, particularly those who also asked some questions. Thank you so much. I hope to see you in a couple of weeks. Have a great day.